Is trading in these equity derivative markets going to trigger the next market crash? This and more in today's video market update. Hi, my name is Stephen Flood, CEO of GoldCore, your precious metal specialist. And today we're going to talk about a really interesting article that I came across in the Financial Times over the weekend. And it goes to the heart of a kind of open question that we've all been asking ourselves. Where has this NASDAQ stock bubble come from? How are we seeing the equity markets at record highs, given the calamity that has been the COVID crisis over the past 7-8 months, and a lot of people were looking at the stock market thinking it's gone up. How is this possible? Is it because of printed money? Is it because of clueless stock investors going in and buying stocks and not knowing what they're about, with phone apps and whatnot? Or is there something that we're missing? Is it because the new work at home model where we all work from our kitchen table means that these tech companies and these purveyors of technologies and communication systems will benefit disproportionately, and therefore this is the new norm. So a lot of people have been asking these questions and what's been going on. This article that I'm going to share with you right now really goes to the heart of actually what's been happening, and it's not at all a pretty picture. Essentially, what's been suggested now is that Softbank, a conglomerate out of Japan, you may have come across. They specialize in private equity and asset management. They are a very, very large company. They invest in companies that are emerging, that have huge potential, require lots of capital, and they've been very, very successful at that for a long time. They were heavily caught out in at the initial sell-off in the market some while back, and had some significant losses on their books, and their future was being called into question. They then sold off some assets that they had in China, raised an awful lot of money, and had begun to rebuild their book of business. In the background, it seems that what in fact has been happening is that this company has been buying up a lot of these NASDAQ names almost surreptitiously, without many people knowing it or realizing it. But they went one step further. They actually were buying stock options, calls to be exact. And what they are a contract where you have the right to buy a stock at a price that tends to be out of the money or above the price where it's trading today. So if the stock is at 100, you have the right to buy that stock at 110, and the hope is that within the life of that contract, the stock price actually rises up beyond 110 and goes to 120 or 130 or whatever it is, a number higher than the strike price. You then get to execute that contract, buy it at 110, and sell it at the higher price for cash difference or whatever it might be. The great thing about options, and they are a very important part of any capital market and the equity markets in particular, is it allows you to put a small amount of money down and get the right to buy an awful lot more of the shares than you have. And so it allows a leverage play on a market for a small amount of upfront capital, and then you can really profit from your convictions. What's been happening here, though, is very unusual. This particular entity has been buying up not only the underlying stocks of all these names you've mentioned, you've come across, like Apple and Netflix and Facebook, Google, and all these top-tier tech companies in the NASDAQ, but also Tesla as well. They've been buying the underlying stock, but also buying up a lot of these option contracts. And what was happening is as these option contracts were being bought, the banks and brokerages that were selling these option contracts had to go and buy the underlying stock in order to protect the other side of the contract. That in itself fueled more price rises. There was a far more buying pressure coming in than selling pressure, as you'd normally see, where the market became much more imbalanced. And these stock prices started to rise far beyond what they would ordinarily trade at. And you were seeing stocks going up 300% and 400%. And as I say, the stock market itself, the NASDAQ, has actually been pulled all the way up and doubling from 6,200 6 months ago to 12,420. Now, the valuations that these stocks have reached recently are eye-watering. Tesla in particular, a very new entrant into the market, with a new technology. Obviously, you've probably come across it. They have had a price earnings ratio of 1,200. Normally, a regular bellwether stock might be around 15 to 18 or whatever it might be times earnings. So you buy the stock for, let's say, $100. You'd expect to earn that money back in earnings over 15 years. And that would justify the stock price, that you get paid the price of the share of 15 years. Tesla, its price earnings ratio, the price of its stock versus its earnings, which would be way down here, was 1,200. So 1,200 years to actually get paid back the price of a share, which is just ridiculous. I mean, I hate to tell you, it's just absolutely insane. It is an insanity. Apple, another well-known stock, its market capital, which is the amount of the value that the market puts on the company, the number of shares times the price, basically hit 1 trillion last year, and that was a big news story. It's one of the first modern day companies to hit 1 trillion in value of market capitalization. It just hit 2 trillion recently, which means in a matter of months it's doubled in value, and its market cap is now greater than the GDP of Brazil. I kid you not, or Canada, which is just insane. So this is indicative of a market that's absolutely stretched its valuation parameters beyond all recognition. As you can see here, this is a really interesting chart. The stock options, which is the tool that's been used to really rally these markets up, they trade around 70 odd billion in value every 10 days on a rolling basis. You can see this gray line here, which is the contracts on individual stocks. It's gone from, let's say, somewhere around 60 or 70 up to about 335 billion, which is extraordinary. No one's actually seen these volumes in contracts. So we know why the market's gone up. Now the question is what happens when this big player pulls back? Does the market drop and crater? If it does crater, what's the damage of that? How many other stocks will be affected as investors get burned and pull out of the market? And now, what happens? How does that affect the real economy? Markets do turn, economies do turn on such events. This is a story that is really interesting. It's one to watch. It might mean that we could see a massive stock market drop and a lot of damage, peripheral damage coming from that too, in terms of confidence as well. It brings us back to the reason why we look at gold. It's a safe haven asset. If you own it and own it in the right location, safely outside of the financial system, those banks that might be caught up and have sold these options and might have huge losses on their book, their ability to store investments or make a market investments may be called into question. So if you own gold through proxies or ETFs or any other contracts that are derivatives of the gold market, they in fact might become compromised due to kind of peripheral damage. That's why you have to own precious metals outside of the financial system, nowhere near banks, in a dedicated vault in a safe jurisdiction, segregated and allocated, not pooled. Segregated and allocated is always best. Pool's good for speculations, but basically segregated, allocated in your name safely is what you need to do. 5, 10, 15, 20% or whatever is appropriate in your case. Anyway, I hope you've enjoyed this market update. It's been great to speak with you today. As I say, if you want to see more of these, we do them quite regularly. There's a bell down here. You can click that. You can subscribe to our YouTube page to get alerted to these new these market updates as they come out. And we hope to see you again. Thank you so much for your time.